All right, folks, here we are on Trading Up. We've got Tanz here from Vertex Investments. We've just done an amazing podcast that you've got to go and check out. Link underneath the video. And he's about to walk us through a price chart and show us his 1 to 68 trade. Tanz, over to you. Hey folks, my sponsors City Traders Imperium have just launched some amazing changes to their funded trader program you got to check out. You can now skip the whole evaluation, trade gold as well as Forex, plus they've increased the drawdown you're allowed in both the evaluation and when funded. With CTI, it's even faster and easier to reach up to $4 million in funding with a 50 to 70% profit share. Click the link in the description to find out what else has changed.
Yeah, so in terms of direction, for me to start off with, the 4 hour and a daily is generally my preferred timeframes for high probability setups. So the whole thing that we focus on is essentially we need to have. Is that clear enough for you to see?
It's pretty clear, yeah.
So essentially, we need to have structured breaks, right? And our entry points are from what originates the first, or what originates the structure break essentially. And these candles are known as several things. They're either OBs, ICs, IFCs, IPAs, whatever you want to call them. I think people change the names for certain reasons. It's up to you what you want to call it, but essentially it's the same thing. And you're looking to trade the mitigation of that candle. Now, mitigation is probably the biggest thing to follow, because mitigation is essentially order flow. So what order flow is essentially is following the mitigation. So for like healthy, I'll just draw an example. For healthy bullish order flow, you want to have mitigation, and so on. And that's healthy bullish order flow. But if you have a situation where you have this, and this generally happens on a pullback of a move, you have mitigation, and it's happening too frequently, that's unhealthy. And that's the only part that can be a little bit subjective to, and it depends on the person that's actually analyzing the chart at that point. But generally, you want to have a nice space between your mitigation points to understand where order flow actually is. So in this situation for AU, and this was actually a chart that I sent to our free Telegram group, actually. I sent this POI here, and I'll explain why that is a POI first. So what we can see is, to start off with, and this is where you have to focus on what each candle is doing. So what we can see is we have this, let me turn my magnet tool off. There we go. So we have this high, and we have this low, and then we have a very impulsive move, which creates this low here. And we have a slight pullback, okay? And then we have this whole move, which creates this low. So in this case, this whole move originated from here, but we also have a break in the move that came from here. And that's a fairly high volume candle. So essentially what you're looking for a down move, you're looking for the last up move. So you're looking for where the buyers have actually entered the market at this point. And obviously you have these little candles here, but in terms of where price derived from, you either have this one or this one. And the way to look for the impulsive nature, we need to focus on the imbalance in price. So to basically sum it up, imbalance is the way the market moves. There needs to be 50% winning, 50% losing, 50% buying, 50% selling, right? So what we can see is there's pure selling here, because in this candle, what we can see here, the issue with me, I draw so much on the chart and I make it look so messy. How should I say? What we can see, I was trying to use in boxes and stuff, but after this candle, we can see there's a gap in price where it's pure selling. And that does require some time to actually get used to actually see that. But that eventually needs to be corrected. And you have to bear in mind, when you get your institutional candles like this, they can either be respected or violated. And I think some of you who are using the free content that we provide are using these and are expecting a reaction, and it's not always going to happen. So we have to bear in mind that our high probability ones come from the higher time frame. And another way to spot this, because on the dailies, what I first saw is, because this is probably a bit more clearer, but what we can see is we have this structure break which creates this low, and we have this solidified high here. But we have this huge wick which pulled back, and focusing on candles such a big thing, because you have to understand what is happening in each of the candles and how price moves. So generally, when there's a huge wick, you know that in this case the sellers are getting exhausted in the wick going up, and the buyers are entering in the market at that point. That's just a quick indication without even going to a lower time frame, without going to the 4 hour. I already knew that there's buyers in this wick just by looking at the size of it compared to like a normal candle wick, for example. Again, that's subjective to the trader. But anyway, in this case, we waited for price to come to this POI. So price was somewhere when I looked at it. Price when I sent it, price was somewhere here. Oh, hold on, I didn't use the replay tool. There we go.
Hey, want to trade crypto and gold like the institutions? Well, you can, and it's free for 14 days with Sage Strategies, fully automated trading strategies. Check out their live track records for 25 unique strategies, plus they host everything for you, which is perfect for beginners to advanced traders or investors. Simply sign up for their 14-day free trial today to experience it for yourself.
The price was somewhere here, and this is what I was talking about in the podcast, where this took, I think, 6 days. Yeah, 6 days to actually reach the POI. Now, I generally wouldn't look at the chart until I need to, until my alerts go off. So my alert was placed exactly at that open, and yeah. So generally, I wait for price for my alert to go off. But what I did, I was a little bit impatient where I looked at price here, and I can't remember where it was. I think it was this one. And this is where we could talk about win rate, but I saw this impulsive move, right? And then I wait for price to get there. I took a trade on the reaction. I think it was here. Yeah, I took a trade on the reaction to here. And again, I've posted this on our Telegram so you can follow the breakdown. But I followed the reaction and I got a trade in. And this is where I was already break even and the price was a 1 to 20. So I closed 10R on this trade anyway. And it was just a matter of waiting to see what happened, even though I know this is not a high probability setup. But in terms of the mitigation point of view, and this is how with every trade you need to make sense of it, right? So what we can see is we can see that we have this low which got broken here, right? And then we have another institutional candle here. Now this candle mitigated that and then created this impulsive low. So that to me tells me that this is substantial enough to look for a reaction there, should we get one. So for me, that was valid. And then what we saw was we had this reaction point, and I had an entry. I won't go too much into that entry because it was a bit of a weird one. But I had a 1 pip stop loss on this one. Thankfully, it was a really nice trade. It went to 1 to 20. I closed half at that point. I would have closed half at 10R, but I just wasn't at the chart or wasn't on my phone to even look at it. So I would say I got somewhat lucky. And then I was already break even at that point. And then price went on to go back up. And I got taken out of break even the remainder of the trade. So I would say that I was wrong on this trade. But in terms of my strike rate is not affected because I didn't lose. I was just wrong in the setup. So is the podcast and this going to be in the same video?
No.
Okay. So if you watch the podcast or listen to it, when I talk about a strike rate and going to break even quite quickly, this is the reason why my strike rate can seem quite high, because I'm already at break even. So I could take break evens quite consistently, I would say. But in terms of losses, the losses aren't really there unless I'm wrong. Because if you're wrong in these sort of setups, you're wrong within seconds. It will hit your stop loss within seconds, which to be fair, I quite like. I don't like sitting in drawdown and you're panicking, you're anxious and so on.
So that trade there was effectively a 5R trade when you consider the fact you took 50% off at 10R and then 50% got stopped at break even.
Yeah, so I took 50% at 20R. At 10R,
oh, sorry, 20R. Okay, right. So it was a 10R trade based on that. Okay, cool.
So I was quite lucky in the sense that I didn't see the trade at 10R, to be fair.
I was going to say, with the one pip stop, it looks like 10R would have been a lot closer than that. So, yeah, that makes sense. Sorry.
Yeah, it would have been. Which is actually a benefit for the strategy because you can secure like your partial quite quickly. So once price actually got to the POI, let me go candle by candle. Okay. Oops. Okay, that's fine. So once price actually reaches your POI, you need to understand if this has actually mitigated anything of significance, because obviously this is a quite big range. It's how big is it? Was it a 36 pip range? And that's quite big, and it means there's quite a lot of space where price can react to above. So what you can understand is if you were to just draw a line from here, just go across to this one. So if I use the replay tool to here, we can see on the 15-minute, we can see that it's mitigated this 15-minute candle here, because what we can see is we have this low, right? Then we create this high, then a new low, and this candle mitigated whatever was here. So pricing is efficient. I don't expect price to go further up because this wick has, I believe and assume, has mitigated something here. It's sort of mitigated the imbalance, so it doesn't really have a reason to go further up. So it's mitigating this candle. So the point of invalidation is going to be this last mitigation here. So invalidation is, the way to describe it in simple terms is looking for the last reaction, and your invalidation is the point above it, if that makes sense.
Just
About. So essentially, what we can see here is we have this low which got broken, right? You need to find where the structure came from, what broke this low. It came from somewhere in this candle, right? Now in this wick, we obviously know, and this is another one where we have a huge wick, so we know the buyers have entered into the market here, okay, that created this low. And then we can assume, and this is all based on assumption, we can assume that this candle and this wick has mitigated wherever it was in this wick that caused this low. So in that case, we shouldn't expect price to go further up. And then what we can see is this is the reaction point. That blue line there is the reaction where price is, where price is at the POI. So you need to ask yourself, does it make sense for price to react there? So if I go back to where we were, so some people would be doing this is, and if you want to trade it on a very simple way, some people can just do this. So they have the POI, and when they find the POI, say the price was here, some people do this where they can place the order at the 4-hour candle, have their stop loss just above. Again, the risk reward is not great. Have the stop loss just above it, and the TP would be the structure point, so it's that structural low. So that's a risk entry in that sense. And this is very similar to how I used to trade. It used to be that engulfing candle. So for me, this whole move would be an engulfing stage or engulfing phase. And I'll place the order at the candle itself or on a fib retracement. That's how I used to trade. So it's essentially supply and demand in that sense. But now it's with the added refinement of studying the reaction. So once we have this reaction, I was on the 30-second time frame. There we go. Let me try to get a better view of it. And this is where you need to understand structure. And this is where, you know, when I was talking about the schematics, is where it makes sense, because to me, to some people, this can be a schematic playing out. But for me, I won't be able to understand the schematics at all. And I think I wasted a lot of time marking out the schematics, and then I ended up missing the move. So by the time I finished the schematic, price is gone. So, you know, I wasn't really efficient. But what we can see is we have our solidified high, and that's the one that caused the mitigation. And we have our low. And essentially, we need to have a change in trend. So the change in trend obviously comes from the breaker structure, right? So we have our solidified low, our solidified high, and that got broken here. And then what we see is we have another break here. That's our second break. Now, the issue is some people would enter a trade of this candle here because that's the one that caused the break, the most recent break. But the issue is you need to think about pricing and its efficiency. So in terms of inefficient pricing, we can see that after this candle here, which is our institution candle, we can see that there's a gap in price. And not only that, pricing is inefficient and is efficient here. Now, that was the last mitigation. So remember what I said about the mitigation point. Our point of invalidation is here. So to have a conservative stop loss, you could place your stop loss above that, but I didn't do that. I didn't need to. So if you want, that's if you want to be conservative. So what I did is from here, if I zoom in, and I don't want to be too confusing to your viewers, to be fair, but that was a candle that caused the move, right? That caused that first impulsive move. I didn't trust it enough to go straight off that, because what you could have done is you place a stop loss, and again had a conservative stop loss above the mitigation point, and then place a TP at that structure point, right? Again, you can have a two, what's it? Okay, let's say 3 pips on this one, just to give a rounded figure. You can have a 3 pip stop, and your target would be, oh gosh, hold on. Your target would be what? A 1 to 45 on that. But the reason why I didn't do that is purely because of this space above. I wasn't sure if price is going to react there or not. But in terms of logic, of taking the trade, it was valid to take a trade on this time frame from that institutional candle. But what I did is I went one step further, and that's what I won't explain, because I think I struggle to pull back my information as to what I give to my students and what I give in public. But what I did further was I went to the 5-second time frame and essentially followed the same exact structure. So you're essentially waiting for, in very simple terms, you're waiting for this. You're waiting for either that. So you either have a liquidity grab, break a structure, then you enter off the institutional candle, or sometimes you don't even have the liquidity grab and you just have that breaker structure. And the way to see it is follow the momentum. So what we can see is prices, and the way to see momentum is just look at the steepness in price. So price is pretty steep coming down, but in terms of going back up, it's very slow. So momentum's in our favor, the structure is in our favor, and we know where price inefficiency is. So we know where price has derived from. Not only that, that's a very high volume candle. There's no wicks on that candle. So it makes sense that the last buys before the sell belongs in that candle itself. So again, taking a trade from there, it would make sense if you wanted to do so. But to be fair, I saw the 3 pip stop loss, and again, this sounds a little bit greedy. I didn't want to take 3 pips, so I went down to the 5-second time frame. And in terms of using limit orders, sometimes you can do it, sometimes you can't. Sometimes you need to do a manual execution. So when price is reacting, that's when I already work out my stop loss size using Stinu. I don't know if you use that or not for
No,
work
not
out
heard
your
of it.
risk.
Stinu.
Yeah, it's a very good app, very quick. However, annoyingly, they started charging now. I think this year, they started charging, I think, £14 for the whole year, which is not bad, but it's a bit cheeky, isn't it? So you can use my FX book, which is free. But I already work out my lot size for 5 pips, so it shows you what a lot size would be for 1 pip, 2 pip, and so on to 5 pips. So I know exactly what I need to put in, because it'll be fairly quick if you're using the seconds time frame. But this is the confirmation I was talking about in the podcast, where since January, being able to confirm a reaction after the reaction has taken place, and again, it probably sounds confusing now, but being able to do this has allowed me to increase my win rate massively, because I was already at break even. Actually, I could probably go. I'll show you where I was break even. So I was already at break even when price broke this structure here. So when price broke this structure, because I see this high here, price didn't have a reason to go back to my entry point. So when we broke structure, so from entry to structure break, oops. Yeah, it was within a minute. I was already at break even.
Damn,
So
that's ridiculous.
that basically explains why the strike rate is so high, because I'm already at break even at that point, and I left it be. I left the trade, and in terms of trade management, and I think I mentioned in the podcast, actually, I'll quickly touch on it. You know, if your entry point is an institutional candle, and if it makes sense for price to come back and mitigate your entry point, I wouldn't move my stop loss to break even. I would take away partials if I wanted to, or just hold the whole trade. So in terms of our losses, the losses would come from this decision right here. So whether you decide to go break even or not, because you always get some sort of reaction from an institutional candle, but whether it follows through or not, you don't know. So this allows me to follow the reaction, and it's that decision-making process of whether you move to break even or not that decides if the trade's going to win or lose. Because if this candle was valid enough, and to me it's not, because it didn't break any structure. In fact, it failed to break. It only broke when it created this reluctance in price, so this failed high that created this low. So for me, it had no reason to go further up. So that's why I moved to break even. But if this candle was my institutional candle, I wouldn't move my stop loss until that's been mitigated. Once that's mitigated, you can do whatever you like with your stop loss, or you can take your partial. So I use 0.5% risk. I would have taken 0.5% somewhere here and left my stop loss where it is. So it's break even either way.
Hey guys, ever wonder what broker I use? Well, I use these guys, Hanko Trade. Look, it was a no-brainer for me because I was looking for a broker with really good trading conditions and one without any leverage restrictions. Look, also, by joining Hanko Trade, I was able to cut my cost of trading significantly with their super low commission of $1 per 100K. Look, if you want to find out more, check out hankotrade.com or there is a link in the description. Cool. This is an awesome breakdown. Have you got more to share with us here, Tanz?
Yeah, so just for your partial points, so if I just place this trade out, so something that I like talk about quite a lot is don't be deceived by the risk to reward you see online, because it's not always the case. Especially my videos, like for thumbnail reasons, yes, it says 1 to 40, 1 to whatever, but as I say in the videos, I take partials. So my partial points are the structural lows. So I took, so I already, on this trade was taken on Friday. It's a stupid time to trade. So I closed 5R at 10R and I left the rest of the trade to run. But my partial points are the structural lows. So I have one here where I took partial yesterday. And I have another one here, which price is approaching. I should take partial soon, probably after this call. And then my final target is here. So although this is a 1 to 68 move, I closed 5R and then I closed 9R here. So I closed 14R. Yeah, 14R. So I have quarter volume left on this trade. So whether I take partials or not, I'm not sure. Or if I because that's only, I think, 15 pips or 12 pips, something like that, from TP. 20 pips or so, something like that. So I don't know if I'll take partial or not. I might do, or I might just hold. But it's only quarter volume, so I'm not really stressed. And I've already taken 14R. So from that trade, so yeah, the way to see it. So it's running at whatever quarter of that is. I can't do the maths.
I don't know either. I can't work it out either. It's all too confusing for me now. Hey folks, if you want 10% off the Vertex Investing Trade Management or their 2-day bootcamp, then use this promo code here at checkout. It's TN10. Use TN10 at checkout on the vertexinvesting.com website, and you're going to save yourself 10% off here with Trading Nut. But hey, look, mate, this is an absolutely fantastic video. I'm sure you guys have stuck to the end, have probably learned about a million things in here, and you're going to go and want to watch it again. Before we wrap up, or let's wrap up, let's stop sharing your screen here. Tanz, what's the best way for the guys to find out more about you and Vertex?
So you can follow our YouTube channel where I actually do these breakdowns in more detail for free for you guys. And to contact us, you can visit our Instagram, so it's at Vertex Investing, and all three of us monitor that account so you can speak to us directly. So yeah, that's the best way to keep in contact. Oh, also our free Telegram group where I post breakdowns as well. This trade will be broken down at some point this week.
Cool.
Whenever
awesome
you
stuff.
I don't know.
Well, that'll be a few weeks ago from you guys watching this. Do go and check out the podcast that we shot just before this. It is amazing. It gives you some more context to what he's just shown you here. There's a link below the video. And guys, do remember to hit subscribe, hit like, and click on that notifications bell. Click all, and you'll get notified when future videos like this one go live. See you in the next one.